Here is something most traders never want to face directly. The biggest threat to your trading account is not the market. It is not volatility, not stop hunts, not unfair spreads, not algorithms front-running your positions. Those things exist and they matter at the margins. But they are not what is draining your account. What is draining your account is you. Specifically, the things you do repeatedly, often without noticing, that quietly undo every edge you've worked to build. The habits so familiar they feel normal. The patterns so embedded you've stopped seeing them as patterns at all. Most traders spend their time trying to improve what they add: better strategies, better indicators, better analysis. The real work is in removing what is already costing you. These are the 7 habits that are most likely sabotaging your trading right now. The first habit is checking your open trades constantly. You enter a trade. You've placed your stop, you've set your target, the thesis is clear. And then you watch it. Refresh after refresh. Candle after candle. Every tick against you tightening your chest. Every tick in your favor giving you a small hit of relief. This feels like engagement. Like being a responsible, attentive trader. It is not. It is anxiety dressed up as diligence. Here's what actually happens when you stare at an open trade. The more you watch it, the more emotionally invested you become in its short-term movement. And the more emotionally invested you are, the more likely you are to interfere with it. You close the winner early because it came back a little, and you couldn't stand the idea of watching profit disappear. You move the stop because price got close and the thought of it hitting was unbearable. You add to a losing position because you've been watching it for 40 minutes and you're certain it's about to turn. None of those decisions come from your trading plan. They come from prolonged exposure to a moving chart while your money is at risk. That is a psychologically destabilizing experience, and it produces psychologically compromised decisions. Enter the trade. Set the parameters. Then look away. Check it at intervals that make sense for your time frame. Not every 30 seconds. The trade does not need your supervision. It needs your rules to be in place and your emotions to be out of the way. The second habit is moving your stop loss to avoid being stopped out. This one is so common it almost feels like a rite of passage. Price approaches your stop. You move it a little further away. Price approaches the new level. You move it again. What was supposed to be a controlled loss becomes something much larger. And in the back of your mind you tell yourself you were being flexible, adapting to the market. You weren't. You were overriding the most important decision you made on that trade, the decision you made before you entered, when you were calm, when you could see clearly, when you placed the stop at a level that logically invalidated your thesis if hit. Your stop loss is not an arbitrary line. It is the answer to a specific question: at what price is this trade wrong? That question has an honest answer and it doesn't change because price got close to it. If the trade is wrong at that level when you enter, it's wrong at that level when price approaches it. Moving your stop is not risk management. It is hope management. And hope is not a trading strategy. Place the stop where it belongs. Let it do its job. A loss taken at the planned level is part of the system. A loss that grew because you kept moving the line is damage you inflicted on yourself. The third habit is trading to recover losses. You have a bad morning. 2 trades, both losers. You are down on the day and something shifts in your thinking, quietly, almost imperceptibly. The next trade you look for is no longer the next qualifying setup. It is the trade that gets you back to flat. Those are not the same thing. And operating from that second mindset, trading to recover rather than trading to execute, is one of the most dangerous states a trader can be in. When recovery is the goal, your criteria loosen. Setups that don't fully qualify get taken because you need the market to give you something. Position sizes creep up because a normal size win won't cover what you've lost. Stops get placed tighter because a wider stop means less recovery per unit of profit. Every decision bends toward the emotional need to undo the damage. And the market has no interest in your recovery. It doesn't know you're down. It doesn't care. keeps doing what it was going to do regardless. And a trader approaching it with urgency and need rather than patience and discipline almost always makes the hole deeper. When you recognize you are trading to recover, stop. It doesn't matter that the session isn't over. It doesn't matter that there are more hours of market time available. You are not in the right state to use them. Close the platform. The recovery happens tomorrow, with a clear head and a clean slate, not this afternoon with a compromised one. The fourth habit is treating near misses as confirmation. Your setup requires 5 specific conditions. 4 of them are present. The 5th is almost there. Not quite, but close enough that if you tilt your interpretation slightly it qualifies. You take the trade, and you tell yourself it was a valid entry. This habit is insidious because it feels like flexible thinking. Like you're not being rigidly mechanical, that you understand the spirit of the rules rather than just the letter. But what you're actually doing is gradually eroding the integrity of your own system. Every time you take a trade that almost qualifies, you expand your definition of what qualifies. Not dramatically, slightly, and then slightly again. And after weeks of this, the setup you're actually trading is a blurry, generalized version of the precise pattern you originally identified as having an edge. The edge came from specificity. The near-miss habit destroys that specificity one small compromise at a time. The rule is binary. The setup either qualifies or it doesn't. Almost is a no. Close is a no. Looks similar is a no. Your criteria exist for a reason and they need to be protected, especially when the market is making you want to enter and you're scanning for justification. The 5th habit is talking yourself into trades you already know are wrong. This is the near-miss habit's close cousin, and it's worth separating out because the internal experience is different. With near misses, you're not sure the trade qualifies, and you convince yourself it does. With this habit, you know it doesn't qualify and you take it anyway. And the tell is always the same. The moment you find yourself building a case for an entry rather than simply recognizing one. When a setup genuinely meets your criteria, you don't need to argue with yourself about it. You see it, it's there, you enter. The internal experience is recognition, not persuasion. When you are talking yourself into a trade, running through reasons why it could work, telling yourself that this particular market condition makes the usual rules less applicable, noting that the last few trades were losers so statistically this one should win, you are not analyzing. You are rationalizing a decision that a calmer version of you has already made. That version said no. You are looking for permission to override it. Notice when you are building a case. And then don't take the trade. The energy spent constructing arguments for a marginal entry is the clearest possible signal that it isn't your trade. The 6th habit is ending sessions on a loss and immediately trying to trade back. The session has been difficult. You're down. The market is about to close or you've hit your loss limit and something in you resists closing the platform. Just one more. The conditions might improve. You can feel a turn coming. If you stop now, you lock in the loss. You are already describing the next trade before it exists. Not based on a setup, based on the emotional refusal to accept that today was a losing day. Losing days are part of trading. Not occasionally. Regularly. Every consistently profitable trader has losing days, losing weeks, sometimes losing months. The difference between a losing day and a disaster is the decision to stop when you're supposed to stop. The loss you lock in by ending the session according to your rules is smaller than the loss you accumulate by continuing past your limit in the wrong psychological state. Almost always. That is not an opinion. Look back through your own history and find the sessions where you traded past your loss limit. Check what happened. The evidence is in your journal. End the session when the rules say end it. The market will be there tomorrow. The 7th habit is ignoring what your journal is telling you. You journal. Or maybe you've journaled, for a while, then intermittently, then not really anymore. And even if you do journal, there's a version of journaling that is just recording trades without actually using what the record reveals. Your journal is the most honest feedback system you have. More honest than your memory, which edits out the uncomfortable details. More honest than your feelings about how trading is going, which fluctuate with recent result. It is a factual record of what you actually did versus what you plan to do. And most traders look at that record and see patterns they would rather not see. You take trades you shouldn't on Fridays. Your performance drops sharply after lunch. You consistently exit winners before the target when the previous trade was a loser. Your largest losses always come from trades where you moved the stop. These patterns are not random. They are the exact places where your psychology breaks down under specific conditions. They are the map of where your discipline goes. And they are actionable. If you know you trade badly on Fridays, you don't trade on Fridays. If you know you close winners early after a loss, you build a rule that prevents you from manually closing a winning trade for 30 minutes after a loss. But none of that is possible if you're not reading the journal. Or if you're writing in it vaguely enough that the honest patterns are hidden. Or if you read it, see something uncomfortable, and close it without acting on what it showed you. The journal doesn't fix anything on its own. You have to use it. Read it regularly. Look for the patterns you don't want to find. And then change the specific thing the evidence points to, not your whole approach, not your strategy, just the precise habit that the data says is costing you. That is the most direct path to improvement available to any trader. And most traders either don't have a journal or have one they don't really use. These 7 habits are not exotic problems. They are the ordinary, daily texture of undisciplined trading. They feel normal because they are common. They feel harmless in any single instance because the damage they do is cumulative and slow. But over weeks and months they build a very specific kind of trader. One who knows the rules and doesn't follow them. One who has a good strategy and produces bad result. One who keeps searching for external solutions to an internal problem. You don't need a new strategy. You need to stop doing the things that are sabotaging the one you have. Pick the habit on this list that felt most personal when you read it, the one that made you slightly uncomfortable, the one where you thought that's me. Start there. Not with all 7. 1. Make it a rule, make it specific, make it non-negotiable. That is the whole thing. Not a dramatic overhaul. Just one less way you work against yourself. Then another. Then another. That is how trading actually improves.